We have the rand trading all the way back down at 6.85 today, and that's after trading above 6.90 for most of yesterday's session. We've also seen the euro dollar moving to above 140. Do you think this is all directly linked to those FOMC meeting minutes that were brought out last night?
Hi, Stephen. Yes, I think most of it is being linked to the FOMC meeting. We did see the meeting really indicating that most of the members in the Fed are also agreeing that monetary accommodation is quite necessary, given especially if the economic growth surprise on the downside, and also, but then the minutes did fail to indicate the size of the asset purchase program, but then the fact that the Fed lowered its GDP growth for 2010 and 2011 and also indicated that the monetary accommodation really needs to be put in place before long, did increase expectations that the Fed will likely move at the beginning of next month.
Of course, as you said, there's no indication of how much, and I think the estimates in the markets are between $500 billion and $1.5 trillion. I mean, how much of this has already been priced into the dollar? Could we see the dollar weakening even further if we do see it coming out at the top end of those estimates?
Stephen, I think most of it is not really priced in yet, and the reason I'm saying that is because there are a lot of uncertainties in terms of the size of the asset purchase program. So I think actually the size will be a swaying factor where the market can actually really move either way given what the size of the asset purchase program is.
Tebogo and manufacturing data out yesterday, 5.3% growth year on year in August, and looks like it came in significantly below market expectations.
Yes, it was below market expectations. Market was expecting an increase of 8.6% year on year, and most of the decline, which was around 3.6% month on month, was because of the strike activity we had in the month of August, which really affected the motor industry. We saw the motor subsector of the manufacturing production actually declining by 19.9% month on month. And given that the rand is still strong, global economy is still really weak, and also the recent PMI data, we expect manufacturing production to remain subdued going forward, which bodes ill for GDP growth in the third quarter.
Do you think this really reinforces the case for another interest rate cuts when the MPC meets next month?
I mean, for Standard Bank, it really doesn't change our view. Standard Bank is still expecting rates to remain on hold. But then when we look at what's happening in the FRA curve, the FRA curve didn't price an easy or more rate cuts. But then when we looked into next year, it looks like the FRA curve is pricing in around 37% probability of a 50 basis point rate cut around next year.